My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make you a little money. My job is not just to entertain, but to educate, to teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Well, it is just so easy to be negative right now. It's so obvious that things are bad that it's almost too obvious. And that's why I hesitate to pile on with the pessimists, including a day like today where the Dow gained 114 points. S&P rose 0.06%, Nasdaq dipped 0.10%, although the averages spent most of the day well below where they went out. End of the day rally took us positive. This morning, Craig Melvin interviewed me on the Today Show, and he correctly asked, are we going into recession? I stuck my neck out, and I said, no. Will the tariffs hurt? Yes. Will prices go higher? Yes. Could there be shortages? Absolutely. But recessions revolve around employment, and there are still so many more jobs than we have people to fill them. That makes me think it will be very difficult to have a recession this year. Yes, there are plenty of people who are going to get mitigated. That's the term CEOs are using when they talk about getting costs down to offset the impact of tariffs. Mitigation efforts usually mean taking supply chain costs out, but they also mean laying people off. But companies aren't too eager to fire lots of people because they might not be able to get them back when things improve. And yes, things always improve. So, when it comes to the most obvious negative, the coming recession, it may not be a given because it's very hard to derail an economy that's still creating jobs. We'll get the monthly labor report on Friday, and I bet it's going to be fairly robust. That will make it very hard, once again, to slip into a full-blown recession anytime soon. And perhaps in several quarters, we will have a more steady and predictable trade policy. Anything's possible. Second reason why the negativity may be too excessive. I came across this factoid when I was looking at X from this fellow Ryan Dietrich, whom I know I see him on Frank Holland's excellent show in the morning. He said when we have this very rare occurrence, 3 days in a row where the market rallies more than 1.5%, 3 days in a row. We have heard many people say that last week was merely a bear market rally, but Dietrich points out that after this rare 3 day in a row plus 1.5 occurrence, the market's gone higher 10 out of 10 times, and by an average of 21.6%. I usually don't like these historical extrapolations, but 10 out of 10? I'm calling that dispositive. Pretty darn good track record, don't you think? We know we're supposed to be very concerned that there will be shortages on the shelves in many American supermarkets. We know that the Chinese are now charging Americans more than twice the price for priceless goods made by Temu and Shein. Priceless because what price can you put on combustible, flammable goods? I can't think of what these fire hazard outfits should go for, especially when you need to don an asbestos overcoat to play it on the safe side. Chinese clothing business joke. 20th year, I get to do this. I'm willing to bet that the American consumer learns to live with less, even if we don't enjoy it. These tariffs are a government-mandated supply shock, but supply shocks don't necessarily cause recessions either. It's another one of these looming negatives that simply don't have much to do with the price-earnings ratio of AbbVie. We're not going to start selling stocks just because we have to get a card at Costco to get better prices or travel the 2 miles to the local Walmart, which, by the way, if you've gone to Walmart lately, it's a blast. No, I'm not kidding. These two retailers have more market power than any two companies I've ever seen. They can negotiate lower prices with their suppliers to offset the tariffs, including the Chinese. Yes, more marginal players will get hurt. But if you have to go to Costco to get what you need, so be it. High-quality problem. Now, it's easy to say that the stock market has a lot more downside when you're hardwired to believe that the Mag 7 still exists as an outperformance concept. Now, there was a time when seeing these stocks down huge, you knew the rest of the market would get gold. People, that time is now over, okay? It just ended. It's just the media and the ETF creators that are still focused on the whereabouts of the Magnificent Seven. Sure, Alphabet rolled over after the first blush win as people realized that it wasn't making as much money on clicks anymore. I'm ready for Apple to say when it reports this week that it can't sell as many phones in a high tariff world. The long knives have been out against NVIDIA for months now. Today, we learned that Huawei, the blacklisted Chinese tech company, has managed to come up with a rival to NVIDIA's H100 chips. Oh, that's a threat, but who's going to buy it now that NVIDIA is on the next iteration? Some people call it the H200, Grace Blackwell. Would the hyperscalers even be willing to put a Huawei chip in their data centers? Would they be that crazy? Would the White House even let them? When you own a stock like NVIDIA, though, it can be brought down by a headline like this, and what it says is the stock is still, after so many months, in weak hands. January, February, March, April, May. It's been more than 4 months. Wow. Wrong place to be, I guess. You know I believe in it, but wow, the stock is just so soggy. Now, I have news for the soothsayers of the 7. Move on, will you? I got another idea. There are 493 more companies, SP 500. Many of them are worth following at least. The media's obsession must end. The hyperscalers have run into a problem of their own creation. They need more and more computing power, but computing power is real expensive. They can spend tens of billions and still need to spend tens of billions more just to keep up with each other. Yes, that's great for NVIDIA, but like I said, more than 4 months of downtime, it's getting tough. Meanwhile, the only winner should be Apple because it never bothered to develop its own AI and can crib from others because of its tremendous user base. But somehow, in the interim, Apple's found itself in the crosshairs of the 2 most powerful governments on Earth. You might have thought that Apple would have been held out as a champion of American industry when it pledged $500 billion in investment in the United States. But instead, I just hear carping from people that maybe at the end of the day, they aren't going to spend all that money. Apple, you please both China and the U.S., you please none. But in place of the Mag 7 are companies from so many different industries that aren't being pitted against the Chinese or prosecuted by the government or threatened by tariffs. Companies that aren't involved in a high-stakes, winner-take-all, loser-take-none competition like the race for the best generative AI. You're going to hear about from 2 of them tonight. You'll like it. Finally, one more reason why it's too obvious that everything is bad. We read every day that President Trump's approval rating is going down, as if somehow that means the stock market is therefore going to go down. That's confusing the issue. Trump has taken himself out of the running as someone who has anything to do with this market. He has said this repeatedly, but he's a mercurial guy. And if he somehow decides that he cares about the market again, he'll make nice on trade, and stocks, they will soar. Putting it less diplomatically, Trump has been integral to the stock market collapse with his policies, particularly tariffs. And as long as he doesn't care about the stock market, he'll probably keep going, even if the tariffs aren't accomplishing what he wants to accomplish, whatever that may be. But if Trump goes back into first-term mode, I mean, to the moon, Alice. Here's the bottom line. This market's baking in the new Trump, but not the possibility of the old Trump making a comeback. Can you really stay that negative when, in the end, the old Trump could resurface at any moment? I'm not saying it's a sure thing, but it's definitely a possibility, which is why I think you're taking your life into your hands if you try to bet against this market instead of increasing the size of your stock positions, but only on the way down after you return to being oversold. Let's take calls. Let's go to Julio in Pennsylvania. Julio.
Hey, Jim. Thanks for taking my call.
My pleasure.
My son, Fernando, grew up hearing your advice, and now he's in college. He basically lives on Chipotle. He's thinking about owning the stock, too, now. With CMG back from its highs, do you think it's a good time to invest, or should you just stick with ingesting those burritos instead? What are your thoughts?
Great question. I would tell your son this. The stock reported a quarter that people didn't like, and what happened? The stock went up. What does that tell you? We are finally at terra firma, and that is not one of those companies that's going to be, it does have some tariff problems, but not many. And what I would emphasize to you about Chipotle, it's never going to be cheap, but it's rarely down this long. Let's go to Juan in Florida. Juan.
Hey, Jim, first-time caller, long-time listener. Thank you for taking my call.
Of course, I'm glad you called. What's going on?
Jim, I wanted to know your thoughts on Intel. The stock is down bad. There's a new CEO making big moves. Is this worth getting into, or is it dead money now?
Okay, right now it's dead money, but Lip Bhutan is the real deal. If you wanted to buy some, I'm not going to fight you, but I will tell you that they need to raise money before they can rally. But if you think the stock's going to be this low 2 years from now, I think you're making a mistake. I believe in Lip Bhutan. He is real deal. Let's go to Chris in my home state of New Jersey. Chris.
Yes, hello, Mr. Cramer. First off, congratulations on 20 years of Mad Money.
Thank you. Thank you very much.
I would have to say, in the mountain range of financial advisors, you are the summit. There you go.
Thank you very much. Summit of Summit.
There you go. There you go, Summit. So now, a bank stock. It had a reasonable earnings report. They're buying back stock. I know it's not at the top of your list of bank stocks, but I'm curious whether you feel that it's close to a bottomed out, and with rate cuts coming up later in the year, perhaps it may eventually break out later this year. I'm talking about Citigroup.
I want you to buy Citi. It's not my favorite. You're absolutely right. I saw Wells just one more consent decree knocked down. Capital One is my absolute favorite. I think you should buy that aggressively, but I like your idea. All right, now look, there's a lot of negativity out there right now, but you have to stay the course and realize it might not take much for this market to move higher. I'm Mad Money tonight. Should you be getting a slice of Domino's? Good example of what I'm talking about. No tariff problem after this morning's report. I've got this here to get a breakdown of what the quarter delivered, and I like what I'm hearing then. As we celebrate 20 years of Mad Money, I'm ranking some of the standouts since our show first hit the airwaves. And later, how are mining companies like Agnico Eagle reacting to the changing tariff headlines? Should you be in gold? Gold stock? Gold coin? Let's listen. I'm getting the details with the top brass. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.